Hello, my friends. Welcome to the investing lecture on correlation. We're going to be learning how some assets move together, how some assets move apart, and what this means for our trading and investing techniques. So, what we're going to do is we're going to open up with a couple of definitions. Correlation is essentially a measurement of interdependence, which is how two or more objects move together. In the cryptocurrency market, or in any asset market for that matter, correlation generally just means the pattern of behavior when two things are moving together. If two things move up and down together, they're considered highly positively correlated. If two things move in the opposite directions to each other, they're considered highly negatively correlated. What we're going to do is we're going to look at some examples of things that are highly correlated, some things that are negatively correlated, and discuss what that means for us. So there's a big misconception in the cryptocurrency market that just because you hold an altcoin that has a special story or some form of special technology about it, that it's somehow resistant to everything else that's going on in the market. The reality is that the cryptocurrency market and all of the assets within it are more highly related than they are different. This is because they have the same underlying technology and the same underlying volatility characteristics. Obviously, we know that, for example, Bitcoin and Ethereum. Bitcoin is using proof of work, Ethereum is using proof of stake, and one of them is a cryptocurrency with just the coins, one of them is a smart contract network. You can argue these different factors all day, but it doesn't change the fact that the entire market is super correlated because they are both, in essence, cryptocurrencies. This extends to the entire market, so everything is very highly correlated because they have these same effects. This is the same type of principle that really underpins how the stock market moves as well. We know that the stock market is very highly correlated with all the different companies because at the end of the day, they're all businesses and they all share the same economy, and the same economic environment really determines the business conditions in which they operate under. This means that even though they may have fundamentally different sectors that they're working in, some may be in healthcare, some may be in making t-shirts or education or energy or commodities or any of these things. A lot of the time, we're talking the majority of the time, all of them are moving together because they're sharing the economic environment. In that same respect, cryptocurrencies share the same technological, the same sentiment-based, and the same volatility-based environment as well. And this is why all cryptocurrencies are correlated together. So, if you look at this chart that I've put up on the screen now, this is a very basic kind of chart showing you just exactly how the cryptocurrency market works on a very broad scale. This is a chart of Bitcoin and Ethereum. Now you can see that during the 2021 bull market, at the very beginning there, they were uncorrelated because Ethereum was actually moving slightly different to Bitcoin. But after that, they essentially stuck together, and this is how they behave for most of the time. The little bit of outperformance that Ethereum had, or how the behavioral dissimilarity in the first few months of 2021, that was the exception, not the rule. You will see that for the majority of crypto's history, on any coin for this matter of fact, that they all follow Bitcoin. And you can see this very obviously on the next chart as well, which is where I have collected a whole bunch of different mid-cap and large-cap tokens, and I've plotted them against Bitcoin, and you can see that ultimately everything does follow Bitcoin. The entire market is very, very, very correlated to Bitcoin. Everything follows it because it is the big daddy of all the cryptocurrency market. That is because it is the biggest. So to highlight this point, what we're going to do is we're going to go a little bit deeper and show you the actual measurement of correlation, because correlation isn't merely a descriptive word, it can be actually measured as well. Now, correlation operates on a scale of +1 for very highly correlated. This is actually perfect correlation, +1, and then it goes all the way past 0 to -1. -1 is perfect inverse correlation. This is where things are moving in opposite to each other perfectly. And correlation moves on this scale from 1 to -1, and it floats around that area because it's constrained by these measurements, and it will tell you the strength of the correlation between these two things. So if you look at this chart, what you can see is actually this measurement, and everything is extremely highly correlated, as you can see. Green represents positive correlation, and all of the correlation measurements on this correlation matrix is showing greater than 0.5, which you would consider to be strong positive correlation. You can see Ethereum, for example, over the 1-year time horizon, has a correlation of 0.89 relation to Bitcoin. This means that the two of them are very highly correlated. That's good. You will also notice that in the top right-hand half of this correlation matrix, we have little horizontal bars within each of these cells. This is just a measurement of the significance of the correlation, which means whether or not the relationship is very solid or not, or whether it means anything. But ultimately, we know the correlations mean something significant because of the nature of the whole cryptocurrency market. The relationship has been strong like this for essentially the entire market history because of the reasons which I mentioned previously. Now, at a high level, what does this all mean for our cryptocurrency portfolios? Well, ultimately, this means that diversification in the cryptocurrency market, broad diversification, is mostly a psyop and a lie. If you have a portfolio that's full of different altcoins, full of different speculative bets, even if you have a whole bunch of different majors, they're not going to do a very good job of protecting your portfolio. It's going to increase your workload, and it's not going to make any difference really regarding performance. It's not going to increase the performance. It actually may just serve to decrease the performance overall. So this means that when you're doing investing analysis, you're going to have to be looking at Bitcoin for all of your directional biases, essentially. If you want to know where the market is going, look to Bitcoin. If you want to know where XRP is going, look to Bitcoin. If you want to know where Cardano is going, look to Bitcoin. You get the idea. So what about the strength of this effect? So you will find that over the long and medium-term time horizons, correlation like this, where the cryptocurrencies follow each other quite strongly, is at its strongest. You will find that over the shortest term time horizons, this effect actually breaks down. So this is the only real exception to the rule. A good metaphor for this effect would actually be walking the dog. So if you imagine you begin walking the dog and then you go for a walk and you come back home, you covered a long distance. And while you're walking the dog, it's going in random directions all around you at all times. However, you both end up at about the same place. This is the same type of effect that you have with correlation. As you're going along over short-term time horizons, cryptocurrencies will be moving around and they will be mostly uncorrelated over short time horizons. So we're talking like hours and days. However, over the course of weeks and months, they follow each other as they're all going in the same direction. Now, there is one important exception to the overall correlation rule that we have in the market. And this is where cryptocurrencies are so small that they don't have any major connections to the large cap coins in the market. And they can operate more on their own fundamental flows. This means if you have a very, very small cryptocurrency, something that is super tiny or something that, essentially something that is just very small, if you have a news release or something that relates specifically to that token, you have a higher than normal probability of that actually outcompeting the correlation effects in the market and having it do its own thing. Or if there is a very small token and it has a very strong fundamentally biased narrative in the market. For example, if you had a celebrity like Ronaldo investing in NFTs or something, and it was this tiny little NFT project, that's the type of thing where it can get blown way out of proportion because you have a token with essentially no volume, no size, and you have a huge amount of people crowding into the same thing at once. Now that is the exception to the rule. We can use this to our advantage, but only in rare circumstances. But it's worthwhile noting that those are the two main correlation considerations. Everything in the market is correlated to Bitcoin except for some of the very, very small projects. Now, much like walking the dog, over longer term time horizons, the correlation relationship between Bitcoin and other asset classes can actually change over the medium term as well. So you will find that while there are some classic correlation relationships in the market between cryptocurrencies and traditional assets, they can move around over time on a more broad basis. So while it's important to understand how they work together most of the time, you also have to understand that they're not a straitjacket. So these relationships can move, and you should never rely on them and be like, yes, something is 100% going to happen. because that's not the case. But we use different correlation analysis to know when to look at it and when to ignore it. So let's get into it now. So you will find that Bitcoin is highly positively correlated to stocks. This is because they share the same risk-on appetite type of behavior in the overall global economy. When people are seeking to make more money, they use stocks, and as an extension, they also use cryptocurrencies to reflect this same effect. Bitcoin has a strong negative correlation to the US dollar, or the DXY, depending on which measurement of the US dollar you're looking at. This is because Bitcoin is denominated in US dollars. People have to buy Bitcoin with US dollars. Generally speaking, this means that when there is more demand for Bitcoin, there's less demand for dollars, and when there's less demand for dollars, there's more demand for Bitcoin, and vice versa. This is a very general relationship, and that statement that I just made is extremely not comprehensive. It doesn't really encompass all the different dimensions of that relationship. However, this relationship is approximately correct. It's a negatively correlated one. Bitcoin also has a positive correlation to the Fed balance sheet. This is because it has a strong relationship to how it affects the risk appetite in global financial markets. When the Fed balance sheet is going up, this increases the risk appetite globally, which means more demand for risky assets like stocks and cryptocurrencies, and vice versa. When it goes down, it decreases the risk appetite for these assets. So if you want to get a little more detailed with this, before moving on to the investing masterclass, you can create a correlation table of your own to collect this different correlation information so that you can keep an eye on it while it's happening in real time. Remember, like I said before, these relationships are traditional, however, they do move around over time. So sometimes some of these relationships will be more relevant than others, and then you have to swap between them. So I'm going to show you now how to collect this information quickly. It's going to be very basic, but it'll give you an idea of how to create your own correlation table before you move to the masterclass so that you can keep an eye on these relationships yourself. So go into TradingView and open up the Indicators tab and find the correlation coefficient indicator. Put this onto your chart and make sure the symbol is a Bitcoin symbol of some sort. Here in this example, you can see that I've made it Bitstamp with a length of 15. However, you can change the length depending on what you want. I will show you what I do in the following slides. So what you do is that you then pull up the stock market and then you have a look at the correlation coefficient indicator. Notice how over the last 15 days, you have a negative 0.68 correlation. What you do is you put this into your table as so, under the 15-day column, and then you go back to your stocks chart, and then you make it 30-day, and then you put in that measurement, and then you make it 90-day and 120-day, and then you make an average of that row. So you take an average of those 4 different measurements, and it gives you an average of the correlations across all those time horizons. You repeat this process for the US dollar. Notice how in this chart, the 15-day correlation is 0.73, and you put that into your table like so. You have 0.73 here, and you repeat that for the 30-day, you repeat that for 90 days, you repeat that for 120 days, and then you take an average of all 4. It's worthwhile noting that it's easier if you just pull up 4 different variants of this indicator, 1, 2, 3, 4, and you just have the measurements for the days set for each one of these. So 15, 30, 90, 120 days, and you just change from chart to chart. You change from stocks to gold to dollars, and you move across and you take the measurements like this. This is probably the fastest and the easiest way to do it manually, and please use Google Sheets for this process because it's easy and you can share it with other people if you want to share it. So in summary, the 2 main rules when it comes to correlation for cryptocurrencies is as follows. Number 1, everything follows Bitcoin and there are basically no exceptions. Over the long and the medium term, there are no exceptions. Over the short term, sure. However, we're not going to be exploring that in the investing series. Number 2, very, very small tokens can be uncorrelated to Bitcoin and uncorrelated to the rest of the market because they're so small that they can operate off their own fundamental flows. This means that market cap is generally a decent predictor of cryptocurrency correlation to Bitcoin. Point number 3, is that Bitcoin has classic correlations to traditional assets. For example, its positive correlation to stocks and its negative correlation to dollars. These correlations move around over time, so it's always worthwhile keeping an eye on them, having your own correlation table so that you can keep an eye on these relationships and you can be prepared for when those classic correlations show up so that you can take advantage of those. We're going to be exploring how to do this in more detail in the Investing Masterclass, but for the moment, I thought that this was a good general introduction to how correlation works in the market so that you understand that Bitcoin really affects everything, and that if you have a delusion that you have some sort of a special altcoin and it has some magical narrative or some special technology and you think that it's very special, it's not really special. All you're really doing is buying a leveraged Bitcoin bet through the market beta mechanism. And this is a very key point. So I want you to keep this in mind. The altcoins aren't special. Everything's correlated to Bitcoin. Small caps can be uncorrelated at times, and traditional assets have their own correlation dynamics. So with all that being covered, thank you very much for listening, and I'll see you in the next one.